Hello everyone, welcome to another class for CFA Level 1. In today's video, we will be doing the remaining portion for binomial model, and the name of the topic is hedging and replicating position. Now before we start with hedging, I'll just give a brief description about what hedging is, assuming that you are hearing this term for the first time. Okay, so let us understand what is hedging. See, the concept of hedging, you will be understanding more in details in other topics of CFA. But since this topic has come, so I am giving you a brief description around it. What is hedging? Hedging, it is a risk management strategy that essentially reduces risk to an acceptable level. Okay, so what is hedging? Hedging is a risk management strategy. So whenever basis our investment actions or decisions, an investor takes a risk or someone takes a risk and he is not willing to accept that risk in the entirety, he will take some other positions in order to reduce that amount of risk. So the activity or the actions that are done by him in order to reduce the exposure, in order to reduce his risk, is known as hedging. Okay, so for example, if suppose we have sold a stock, okay, so when the position is selling a stock, which means that if the price increases, we will incur a loss. Yes, so this is a risk to us. So someone might hedge by buying a stock. How buying a stock will reduce the risk? So when the stock is sold and the price increases, I am having a loss. But if I buy a similar quantity of stock and the price increases, I will have a profit. So this profit and loss offset each other. Guys, yes or no? And now the number of stock he will buy in order to offset his position of stock being sold depend upon the kind of hedging he wants to do. Either it can be partial or it can be complete. Okay, so this is a brief description about hedging. Now we will understand hedging in the context of options. Okay guys, now let us read it in the context of options. What is hedging? Hedge ratio. Hedge ratio is the ratio which provides for the proportion of asset which has to be bought or sold in order to offset the risk position associated with options. Okay, let us understand this line. Okay, suppose we are entering into an option trade, okay, where call option is sold. Okay, the price of the stock is 10, the exercise price is 11. Now, as per the binomial concept, there can be only two possible paths. Either the stock can increase to 12 or any other amount, or the up move factor. Guys, yes or no? As per the up move factor, or it can go to maybe 9 as per the down move factor. Guys, yes or no? See, you have to understand over here what has happened. The call option is sold, which means the person has an obligation. Obligation to what? Obligation towards the call option buyer. And when will the call option buyer exercise his right? A call option buyer will exercise his right when the prices has increased. So he will exercise it when the price is 12. When the price is 12, the payoff is given as max of 0, 12 minus 11, which is 1. So in this situation, the call option seller will technically have to pay $1 Yes or no, guys? He will have to pay technically $1. Over here, the payoff will be 0. So there is no payment. So in this entire transaction, the call option seller is at a risk of making a payoff of $1. So the hedge ratio, the risk of making a payoff of $1, or he may not make a payoff when prices have fallen down. Yes or no? Guys, correct. What will hedge ratio do? Hedge ratio will provide the equivalent number of stocks to buy, which will result into the same portfolio value irrespective of the stock going up or going down. So guys, we will see it once more. What is hedge ratio saying? See, the concept of hedge ratio arises from the fact that whenever a person enters into an option trade, he is exposed to a risk, he is exposed to an uncertainty depending upon the movement of the prices of the underlying. Now, if the price increases in case of a call option seller, he will have to make a payoff. If the price decreases, he will not have to make the payoff. So there is a risk associated in this entire transaction. The hedge ratio provides me with the number of stocks I need to buy in this situation so that the value that is available with the person who has sold the call is same, irrespective of the fact that whether the prices have gone up or the prices have gone down. Are we clear? So basically, in this entire transaction, if I add a hedge ratio into number of stocks, okay, the resultant will be such that the portfolio value is constant even no the portfolio value is constant irrespective of the movement of stock price. Okay guys, so basically hedge ratio arises from the stem of risk management, where we need to effectively reduce the risk to an acceptably low level. In case of options, since there are risk associated with different payoff at different level of share with different level of under prices of the underlying, we buy a offsetting position of the underlying in order to ensure that irrespective of the movement of the prices, the value of the portfolio available with the person who has taken the option remains the same. Guys, are we clear? Are we clear? What is hedge ratio? Guys, are we clear what is hedge ratio? Don't worry guys, we will see it with the help of an example as well. Okay. Now, how is hedge ratio calculated? Logically, hedge ratio is nothing but a simple unitary method calculation Hedge ratio is nothing but a simple unitary method calculation. So guys, hedge ratio is a simple unitary method calculation. There is no hi-fi concept involved. The reason why I'm directly presenting you the hedge ratio, not the derivation, is that the derivation makes it confusing, and in most of the content that is available, the derivation of hedge ratio is shown, but we will not get into the derivation for two reasons. First, the derivation is not relevant for the exam. Second, it makes things more confusing. So we'll directly look at what a hedge ratio is. A hedge ratio provides in the numerator payoff when the option is in the money, payoff when the option is out of money. So guys, tell me one thing. What will be the payoff when the option is out of money? It will always be zero. Guys, yes or no? Guys, what will be the payoff when the option is out of money? It will be zero. What will be the payoff when the option is in the money? In case of call, it will be S1 minus X, and in case of put, it will be X minus S1. Yes or no, guys? In case of call, it will be S1 minus X, and in case of put, it will be X minus S1. Okay. Till this point, it is okay. The denominator, upward price of the stock minus downward price of the stock. So basically, in the numerator, it is the delta between the payoff of the options divided by the two nodes of the stock prices, two nodes of the prices in case of a binomial model. So in the numerator, it is the delta between the payoff of the options. In the denominator, it is the delta or the difference between the prices of the underlying. Yes or no, guys? So now with this, let us take an example. Okay. A person wants to sell a call option on stock A. Okay. The relevant details are as follows. S0 is $20. S1 plus is $32. S1 minus is $14. Guys, I hope you understand what is S1 plus and S1 minus. S1 plus is the node where the stock price is increasing. S1 minus is the node where the stock price is decreasing. Okay. X is $25. What is X? I hope you understand. X is nothing but the exercise price. Exercise price. Okay. The person is also interested to buy stock in order to hedge its position. Kindly show the hedge when he buys the exact number of shares as per the hedge ratio. Okay, guys, I hope the question is very clear. A person wants to sell a call option on stock A. The details are given. The person at the same time also wants to hedge the position. Why do he want to hedge a position? He wants to be certain that the portfolio value remains predictable, remains constant, irrespective of the movement of the notes. Okay. Now we will look at the solution. So the price is given as 20. It can go to 32 or it can come to 14. Exercise price is given as $25. So the payoff is given as 0 comma payoff is equals to max of 0 comma 32 minus 25, which is 7. Over here payoff is max of 0 comma 14 minus 25, which is 0. Okay. Hedge ratio is given as payoff when the option is in the money. So it will be 7 minus payoff when the option is out of money, divided by up move minus down move, which is 7 by 18, given as 0.39. So what does the hedge ratio of 0.39 indicate? So a hedge ratio of 0.39 indicate that for every one call option sold, the person needs to buy 0.39 stocks in order to hedge the position. So what I've written, a hedge ratio of 0.39 indicates that for every one call option which is sold by the person, he has to buy 0.39 stocks. Now, assuming that a fractional stock can be bought, okay, otherwise we will have to convert the stock into one and buy the relevant number of options. However, not increasing the complexity of the question, what we will assume is that assuming person has sold one call option and bought 0.39 stocks. Now let us see the portfolio value. Now let us see the portfolio value. At each stock price movement. Okay. So what will be 20 moving to 32, 20 coming down to 14. So what will be the value of the portfolio? The portfolio value will be given by stock value plus minus payoff. Yes or no, guys? Yes or no? So what will be the stock value? Stock value will be 0.39 into 32. Yes or no? Payoff will be plus or minus. Over here, since we have sold the call, which means when the price increases, we'll have to make a payoff. So it is minus 7. what is the computation? 0.39 into 32 minus 7, 5.48. In case when the call option comes down to when the stock price comes down to 14, what is the value of the stock? 0.39 into 14 minus payoff will be 0. Why? Because the option will expire out of money. What is the value? 0.39 into 14, 5.46. So this 5.48 and 5.46 is approximately equal. Just some, you know, uh, approximation error. So over here, what did we see? What did we observe? We observe that by buying stocks at the rate 0.39 for every one call option sold, the seller is immune to stock price movement. Guys, yes or no? See, otherwise, what would have happened if the stocks were not owned? Then what the value a person would have had? In case the price have moved to 32, it would have been minus 7, and when the prices has fallen down to 14, the value would have been 0. So there are different values at different modes, at different nodes, at different price movement. However, with the stock being bought at a rate of the hedge ratio, see, the value of the portfolio remained constant. So the person becomes immune to movement of the stock, immune to the movement of the stock prices, guys. Guys, are we clear? Guys, are we clear? What does hedge ratio do? Okay, I hope we are clear, guys. Then we have a small concept. So hedge ratio was this portion, hedge ratio. The second portion we have is replicating positions. What is replicating positions? Basically, replicating position means that the value which we are supposed to get from a call or a put, we will synthetically create a portfolio which will give us the same value. So for example, let me give you an example. Suppose we have sold a call over here in our example, right? The payoff of the call being sold is minus 7 and 0, correct? Replicating position means that in we will create a portfolio by selling the stock or by doing activities such that the payoff of that portfolio will be minus 7 and 0. Means it will be equivalent to the call being sold, but we will not sell the call, we will replicate the payoff. That is known as replicating positions. So very small topic. For call options, it says that the value of the call option can be determined by replicating through shorting a call option and going long on the stock basis the hedge ratio. So basically, call option value we can get by C minus, call minus, and then going long on the stock using the hedge ratio. Similarly, in case of put options, the value of the put option can be determined by going long on the put option and long on the stocks by the hedge ratio. So basically, we can derive the value of the call as well as derive the value of a put by going long on the stock and long in case of a call and short in case of a short in case of a call and long in case of a put. So this is a small concept linked to the hedge ratio. Guys, with this we have completed our binomial model for option valuation, one of the important topics for level 1, from which you can expect an exam question. Now what we will do, we will do the remaining 2 questions which were left from the previous day. Hey guys, so we will do the remaining 2 questions. These 2 questions are based on replication and hedge ratio. So let us look at it. The data of the question remains the same. The data of the question remains the same. Put is to be bought. Exercise price at 100. Existing price 105.25. The basic data is same. The risk-free rate is given. So yeah. If client observe that we are doing question number 2, guys. We are doing question number 2. If client observe that 1 year put option with a 100 exercise price is trading at 250. So over here we are given that at what price the put option is trading. In the previous class, if you remember, we were identifying or calculating the theoretical price at which the put should trade. What was the number? What was the theoretical price at which the put should trade? The theoretical price was 2.785. So basically, something which is worth 2.785 is trading at 2.5. Okay, it is trading at 2.5. Which of the following statement best describes how client should take advantage of this to earn risk-free return greater than 0.37 over the year? Okay, what is the question trying to communicate to us? The question is saying that puts theoretical value is 2.785 and put is trading at 2.5. Okay, put is trading at 2.5. The question is saying us what should be done to earn a risk-free rate of more than 0.37%. So we are given that the risk-free return is 0.37, but the question is saying that there is a difference between the theoretical put value and the actual put value. Basis that, what should we do? See, there is one basic rule in finance. Anything which is undervalued should be bought. Okay, and anything which is overvalued should be sold. Okay, this is the basic rule in finance. Guys, remember it. Basic rule in finance. Anything which is undervalued, you should buy it. Anything which is overvalued, you should sell it. Okay. Now, when the theoretical value is greater than the actual value, actual price. So now, guys, you tell me, is it undervalued or is it overvalued? If the theoretical value is greater than the actual value or the market value, whether it is undervalued in the market or overvalued, guys, we can say that this put is undervalued in the market. Okay. Now, when something is undervalued, what is the rule? We have to buy it. So we have to buy the put. Okay. We have to buy the put. But we have one more stipulation in the question. What is the stipulation? The stipulation is that we have to do something so that we earn a risk-free return. See, buying a put has a risk in its own, right? Why is there a risk? Buying a put has a risk that if the market price increases, my put will expire. My put will expire without any value. I will not get any payoff. So when I'm paying $2.5 for something, in case of a put, I have the possibility of getting a return. At the same time, I have a possibility of getting no return as well. But when we are saying that we have to earn a risk-free return, what does it mean? It means that I have to be certain that I get some return. Yes or no, guys? Because the question wants me to earn risk-free return. The question is not asking me to earn return. The question is asking me to get risk-free return. But one interesting hint that is given to us in the question is that the put is trading at a less price than the theoretical value. So it is undervalued. Undervalued things are to be bought. So we have bought it. Now what we have to do, you only tell me, what we have to do in order to convert this position into a risk-free position. We have just now studied. We will use the hedge ratio. Correct? Hedge ratio on stocks. Correct? Guys, are we clear? We will use the hedge ratio. Now let me tell you guys a logic of how do you understand whether you need to buy a share or you need to sell a share. See, over here when you buy a put, what is your risk? When are you getting a payoff? You will get a payoff. Payoff is positive only when the price go down. So when the price goes up, we will get nothing. So can we say that the business is undergoing a risk or the transaction is under a risk of no payoff when the prices goes up? Can we say it? Okay. Now in order to convert this into a risk-free position, what do I need to do logically? I need to get done with this position, this problem. See, I am earning a return when the prices will go down. So I am happy. Let the prices go down. But where am I having a problem? I am having a problem when the prices go up. So in order to convert the position into a risk-free position, I need to do something where I am also happy when the prices go up. And when I will be happy when the prices go up? Only when I have a stock. Only when I have a stock at hand, the prices go up, I will be happy. Why? Because the value of my stock will go up. Guys, see, just let us take an example. Just let us take it in reference of the previous example that we had taken. In the previous year example, we had sold a call. What is the risk in case of call being sold? In case of call being sold, the risk was prices going up. Why? When the prices go up, I will have to make a payoff. When the prices go down, I am happy. Why? Because it will expire. So again, in case of call being sold, what was the risk? The risk was prices going up. So what did we do? We bought a stock. Guys, are you getting me? So whether to buy a stock or whether to sell a stock depend upon the fact that what risk are we negating. Guys, are we clear? Whether to buy a stock or whether to sell a stock depends upon the fact that what risk we are negating. Over here, what risk we are negating? We are negating the risk of prices going up. Now with this understanding, what is the hedge ratio? What is the hedge ratio? Hedge ratio is payoff when option is in the money minus 0 because it will always be, when the option is out of money, it will be 0, minus up, minus down. Yes or no? What will be the payoff when the option is in the money in case of put? It will be 100 minus 94.725 minus 0 divided by 117.9 minus 94.725. So it is 100 minus 94.725 divided by 117.9 minus 94.725, 0.23. Yes or no, guys? It will be 0.23. So basically, in order to convert the entire position into a risk-free position, we need to buy 0.23 of the physical stocks. Now let us see the options. Kleinert should purchase the put option. Yes, they should purchase the put option. Why? Because it is undervalued. And also purchase approximately 0.23 shares per option to match the hedge ratio. Yes, we have just now calculated it. So option A is correct. Okay, but now let us see why the other two options are wrong. Let us first see option C. Kleinert should purchase the put option. Yes, it is correct. And purchase 47% of the underlying shares to match the risk neutrality. We know in case of hedge ratios, there is no concept of risk neutrality as such. Hedge ratio is totally based on the fact that I need to offset my risky position. Let us see option B. Kleinert should purchase the put option and purchase 50% of the underlying given the 50-50% chance. Again, rubbish. So option 1 is correct. So option 1 is correct. Okay. Let us see question number 3. If the risk-free investments yield a higher return over the next year. So basically what it is saying, the risk-free investment yields a higher return. So basically the RF is greater than 0.37 now. We were given RF is 0.37. The question number 3 is saying that RF is greater than 0.37. Which of the following statement best describes how this would affect the no arbitrage value of put? So basically what it is saying is that earlier RF was 0.37. Now RF is greater than 0.37. So what will be the value? What will be the impact? Impact on put option value. Guys, what will be the impact on put option value? So what was put option? Put option value was nothing but yes or no, guys? Any option value of any option can be given like this, guys. Value of any option can be given like this. Now with RF increasing, what will happen? Your denominator will increase. Yes or no, guys? And what will happen when the denominator increases? Your entire number will come down. It will fall. When you increase the denominator or decrease the numerator, your number will go down. So fall in the value. So basically when the RF is increased from 0.37 to something else, my put option value will fall. Now let us see the options. An increase in the risk-free rate will have no effect on the spare coins put option price, as it is solely a function of probability and degree of share price increase or decrease. Is it right? Is it right as per the formula? What was the formula? We have seen the formula in the previous class as well, and in the current class this is the formula. What it is saying? It is saying that put option value is, the value is based on the payoff and the probability. Is it correct? No. Put option value is also dependent on the risk-free rate. So option A is wrong. What is B? An increase in risk-free rate will increase the value of put option, as it will increase the risk neutral probability of price decline. So what it is saying? It is saying that when RF increases, okay, the put value will also increase. Is it sounding logical? Is it sounding logical? No. So it is also wrong. What is C? An increase in the risk-free rate will decrease the value of put option. Yes. As it will both increase the risk-free neutrality of price increase and decrease the present value of expected payoff. So the present value of expected payoff will go down. Major content. So for question number 3, the correct option is C. Guys, are we clear? Guys, I hope with the explanation, example and the questions we have solved, binomial model is completely clear to you guys. In the next class, we will start with a new topic. Thank you and happy studying.